Hi everyone, my name is Ivan Tana and my partner is Vanessa Rayfand, and we will be going over the QuickBooks Chapter 9, the QuickBooks Online Adjustments. To begin with 9.2 to 9.3, which is the accounting cycle and the trial balance. Now, the accounting cycle is a process that businesses follow to record, adjust, and summarize financial transactions for a given period, typically 1 month, a quarter, or 1 year. Now, it all starts with the chart of accounts, which is a list of all accounts used to track financial information. And these accounts help accumulate data about assets, liabilities, owner's equity, revenues, and expenses. The chart is created when the business is first established and serves as the foundation for the entire accounting system. Now, throughout the accounting period, transactions are recorded, and these transactions can involve customers, vendors, employees, or owners, and each transaction affects the account. Next comes the trial balance. This is referred to as an unadjusted trial balance because it is prepared before any adjustments are made. It lists each account along with its balance at the end of the accounting period, and the purpose of the trial balance is to verify that the accounting system is in balance, meaning that the debits equal the credits. Now, after the trial balance is prepared, adjustments are needed. These adjustments bring the accounts up to date, ensuring accuracy in financial reporting, and adjustments are entered in the journal using debits and credits. And once the adjustments are made, the adjusted trial balance is prepared. This ensures that the accounting system still balances after the changes, and if more detail is required, the general ledger is printed, listing all the transactions that have affected the accounts. Next is the financial statements. Financial statements are prepared for external users, such as investors and tax authorities. Now, these reports include the profit and loss statement, the balance sheet, and the statement of cash flows. Additionally, income tax summary reports and management reports are also generated. And moving on to the trial balance, in QuickBooks Online, creating a trial balance is simple. You simply just have to go to the Reports tab, select Standard, and in the Form My Account section, you would select the trial balance, and then you have to export it as a PDF or an Excel, whichever you need. Moving on to 9.4 to 9.6, which talk about adjusting entries. Adjusting entries are required at the end of an accounting period to update the accounts, and these entries are dated on the last day of the period and typically follow the preparation of the trial balance. Adjusting entries ensure that the financial statements are accurate. Now, to save time, recurring transactions can be used for adjusting entries in QuickBooks, and there are two ways to do this. From the first way is from the journal screen, and the second way is from the recurring transaction screen. Now, in QuickBooks, you can set up recurring transactions in three ways: the scheduled, unscheduled, and reminder. The scheduled recurring transaction are automatic transactions entered by QuickBooks on a specific date. However, for adjusting entries, this may not always be the best option. Now, the unscheduled recurring transactions will appear in the recurring transaction list, but QuickBooks will not automatically enter them. You'll need to go to the list and manually select them, and this option does not remind you to make adjustments. And lastly, the reminder recurring transactions is ideal for adjusting entries as it will alert you when it's time to make the adjustment so that you can keep your records up to date with every period, whether monthly, quarterly, or annually. Now let's look at the different types of adjusting entries. There are four types: the prepaid items, unearned items, accrued expenses, and accrued revenues. The prepaid items are expenses paid in advance, such as prepaid insurance or rent. The unearned items are payments received from customers for goods or services not yet provided. And then the accrued expenses are expenses that have been incurred but not yet paid or recorded in the accounts. Lastly, the accrued revenues are revenues that have been earned but not yet collected or recorded. Adjusting entries usually affect both the profit and loss accounts, also known as the revenues expenses, and the balance sheet accounts. In this instance, it would be the assets and liabilities. And that concludes my part of the presentation. I'll be passing it off to Vanessa.
Good day, everyone. My name is Vanessa Rafin, and I'll be continuing the second half of this presentation. Prepaid items are items paid in advance, such as prepaid insurance or rent. An adjustment may be needed to report the amount of the prepaid item not expired. For depreciation, this allocates the asset's fixed costs over its useful life. Adjusting entries for prepaid items affect expense accounts and asset accounts. Adjusting entries record the amount that needs to be transferred between the two accounts. An example of this can be seen with prepaid insurance affecting the expense account of insurance expense and the asset account of prepaid insurance. Prepaid rent affects the expense account of rent expense and the asset account of prepaid rent. And office supplies affect the expense account of office supplies expense and the asset account of office supplies. As a review of the accounts affecting debits or credits, for the account types of assets and expenses, debits increase it and credits decrease it. For liabilities, equity, and revenue, credits increase it and debits decrease it. To end this slide, an adjusting entry with prepaid items may look like this. Insurance expense and expense account would increase our debits by $100, and prepaid insurance and asset account would decrease our credits by the same amount of $100. Unearned items are revenue not earned. When a customer pays in advance and they receive the service, the business is obligated to provide the service or return the customer's money. An adjustment may be needed to update the revenue account and the unearned revenue account. These adjusting entries usually affect a revenue account and a liability account. An example of this can be seen with unearned rent revenue affecting the income of rent revenue and unearned revenue, while another unearned item, app subscription, would affect app subscription revenue and unearned app subscription revenue. The following is an example of an adjusting entry. Rent revenue, a revenue account, would increase our credits by $2,000, and unearned revenue, a liability account, would decrease our debit by the same amount of $2,000. Accrued expenses are expenses incurred but not yet paid or recorded, such as accrued interest expense. Adjusting entries for accrued expenses usually affect an expense account and a liability account. An example of this can be seen with accrued interest incurred, affecting the expense account of interest expense and the liability account of interest payable. Also, accrued taxes payable would affect the expense account of tax expense and the liability account of taxes payable. With this, an adjusting entry to show accrued interest occurred are as follows. Interest expense would increase our debit by $30, and interest payable would increase our credits by the same amount of $30. Accrued revenues are revenues that have been earned but not yet collected or recorded, such as interest revenue that has been earned but not collected or recorded. Adjusting entries for accrued revenues usually affect a revenue account and an asset account. The following is an example of accounts used for accrued revenue adjusting entries. For accrued revenues, accrued interest earned would affect the revenue account, interest revenue, and the asset account, interest receivable, while accrued rent revenue would affect the rent revenue and rent receivable. With this is an adjusting entry to show accrued interest earned as follows. Interest revenue would increase credits by the amount of $40, and interest receivable would increase debits by the same amount. After adjusting entries are made, the adjusted trial balance is prepared to view updated account balances and to ensure the system balances. Also, to conclude this presentation, the accounting essentials will be discussed. For accrual basis in accounting, adjusting entries bring the accounts up to date at the end of the accounting period. Revenue is recorded when it is earned or services are provided to customers, regardless of whether cash was received, and expenses are recorded when incurred or when the benefits expire, regardless of whether cash was paid. On the other hand, the cash basis records revenue when cash is received and expenses when cash is paid. On another note, corrections or correcting entries fix mistakes in the accounting system. For example, cash and professional service fees may be incorrectly reported as $2,000, but they should have been recorded for $200. To correct the entry, the incorrect entry is eliminated by making the opposite entry. The professional service fee is removed by being debited, and cash is removed by being credited. Then after the incorrect entry is removed, the correct entry is made as shown. This concludes our presentation of QuickBooks Chapter 9 Adjustments.